Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Wednesday, June 26th, 1 o'clock on the East Coast. Guy Adami, Dan Nathan with you. Market call. Dan, let's get right into it because it is a very interesting day. Let's take a look at the rundown because these are the topics we are going to discuss. Obviously, this big tech concentration continues. I think our man Jensen Wang, or however you pronounce it, is speaking as we speak. Bank yields and currencies, that's a big deal. All three of those things. If it's Thursday, it's typically Butters, but we figured why not do John Butters today on this Wednesday. And if we have time, a little audience Q&A because people have enjoyed that over the last few sessions. Dan, how are you?
I'm doing great, Guy. You know, it's interesting. You said interesting day in the market, and I'm looking at the S&P, and it's basically flat. I'm looking at the NASDAQ composite, which is up like, I don't know, 20 basis points. I'm looking at crude that's flat. I'm looking at yields. We're going to hit all of that a little bit, but there is some interesting things under the hood, right? And so I know we've kind of beaten this kind of narrowness of the market, the lack of breadth, the concentration in a handful of names, but it really does seem to be something. Doug Cass had a note out earlier from Seabreeze, and I think this is interesting. If you're looking at what's working today, it's Apple, it's Amazon. They're both up. Amazon's up 3.5%. Apple on an upgrade is up 2.25%. But you see what he's saying right there. He thinks that this is reaching a little bit of exhaustion in the NASDAQ 100, Guy. What are your thoughts on that? Now, I get it. We could have said this a week ago, 2 weeks ago, that sort of thing, but it's coming up right now.
Yeah, well, it's seemingly by the day the market leadership is narrowing, and we've tried to bring that up, but when the S&P effectively goes sideways to slightly higher, almost on a daily basis, those comments or those thoughts or those, I guess subtleties are sort of lost in the vacuum that is the S&P, and that's fine. But at a certain point, as we've said for a number of weeks, if not longer, that's going to all come home to roost. And I'm with Doug on this one. I'm reading some other things about some of the indicators that a lot of other people look at that are sort of flashing red. A lot of these have been flashing red, Dan, but when the market decides to sort of take those into consideration, that's when things get interesting. I will say this, though, some of the other things that we've been concerned about, obviously, are sort of rearing their ugly head today as well.
Yeah. It's interesting. And a lot of folks would say they look at us, they listen to us on Market Call, on the tape, on CNBC's Fast Money also is like, well, why are you guys always like, glass half, full, right? Why aren't you, or glass half empty?
Half empty.
Yeah, half empty. Okay. But like, what happened to glass half full? Like, can't you find some stuff that kind of make a case for the bull? And I get that, I guess. But the problem is consensus has obviously been very bullish, right? And we have a level of complacency that's very high. We have a VIX that's, 13. We have 381 days, consistently or consecutively without a 2% decline in the S&P 500. And, it's not just us, right? So here's Urian Timmer from Fidelity. This is a tweet, I think, from
JT
yesterday. Yeah, as you call them. The 10 largest companies in the S&P 500 have now outperformed the bottom, smaller 490 by a whopping 112% since the current Nifty 50 era began in 2014. So talk to me a little bit about that, because that outperformance by 10 stocks versus the other 490 in the index of 500 is pretty remarkable.
Hard to believe we've seen it before. I mean, the folks as I'm talking can read more on what's on those slides, but again, we've had Urian on the tape, and he does very thoughtful work. And what it suggests is, and it's not just him pontificating, it's him using data. I mean, people want to talk about the market broadening out, but in reality, it's doing anything but. Now, the bulls will say, and maybe correctly, that at a certain point, those bottom 490 are going to pick themselves off the collective mat and start to participate. And then you won't need necessarily the participation of the other 10. That may be true. Or the flip side of that is, these 10 stocks have been masking, as I've said earlier, a lot of sort of the woes that are out there. And when you just look at it through the lens of the S&P, everything is fine. When you start to dig a little bit, everything is far from fine.
Yeah. And, it's interesting. So when you think about outperformance, we know, the NASDAQ 100, I think at its highs last week was up about 18% from the April lows versus the S&P, which is, I think was up about 11% or so. And we know where that outperformance comes. It comes with like the fact that the top 5 or 6 names are 40% of the NASDAQ 100, the QQQ, right? And those same names make up, 27, 28% of the S&P 500. And so let's go back to the Urian comment though for a second, because I think what's interesting underneath that chart, he says, until recently, the relative performance streak was mostly justified by relative earnings, leaving the relative PE multiple well below the historical extremes set by the other Nifty 50 regimes in the late or in the early late 90s. But recently, this has changed, creating a more significant gap between the PE ratio of the cap weighted index and the equal weighted index. And I think what's important about that is, obviously the earnings outperformance in those top names is allowing for those top names to have a greater multiple. And we made this point on many occasions. When the market bottomed out in the fall of 2022, most of, let's call it 3/4 of the S&P 500 was trading and we had this conversation, I think, with Urian Timmer in late 2022 or early 23, is that, 450 names were basically trading at 13 times, which was a trough multiple, or 14, something like that, right? For the S&P 500, it was still the outperformance on a relative basis by those top, 20 or 30 or something like that.
It's been going on for quite some time. And I think people like me have wondered out loud how long that can possibly last. It's clearly lasted a lot longer than I thought. I mean, all these things again, and we're going to talk about some of them that continue to sort of get worse, not better, are not having any impact on the broader market at all. I don't know. Again, I try to figure it out. I don't know what the tipping point is going to be, but it's interesting, and we're going to talk about Nvidia in a second. But the stock is not doing really much of anything today. It had a decent day yesterday. It's obviously off from those reversal day that we saw last week. But the thing that sticks out to me continually is, how many more times are these stocks, seemingly all of them, going to rally on the same piece of news? And that's when you start to have to get concerned, because quite frankly, I think that's a lot of what we've been seeing. You get the same piece of news from different things, and they all rally in kind. That to me is not a healthy market, Dan.
Yeah, no doubt. I mean, again, we've spent a lot of time on Nvidia. There was a time we spent a lot of time on Apple, and the Nvidia thing is really interesting. So to your point about that big reversal day, it was on June 20th and, ticked above 140,
an all-time high, yep.
And closed that day, at 130.70, right?
Yeah, on the lows.
Yeah, so it's like a $10 reversal, followed through the next day, followed through the day after that, closed on the lows. It was down 6.5%. I think that was on Monday. And so yesterday got back all of the prior days declines. But you said this, and I thought this was interesting. You're like, it's probably going to rally back a little bit. That was a lot in a 3-day period, and then to close on the lows on that third day. And it did. But like, look at today. It opened up. Maybe they can pull up a day chart here. It opened up, or a 2-day chart, and now it's down 2% or so. So you thought that there's a chance that was probably a good opportunity to lighten up a little bit, and then you think it's going to make a new low. If it makes a new low, God, that 50-day moving average, is down there at 103. That's down about $20 from here.
Yeah. Okay. So it's interesting. And I see that's the chart that Amanda just put up, but go back to that prior chart real quick. Yeah. And, what I want to try to do again, and, we had this conversation on Fast Money last night, and what I said last week and what I said earlier this week is what we saw on the 20th reminded me of what we saw back in early March. And, what I also said was, listen, you had a series, and Amanda or Jacob can put the cursor back to March 8th and go across, and you'll see, we had a series of sideways action. There was a period of time in late March where Nvidia actually rallied, but it did not take out that prior high. And then you obviously had the cascade lower into the middle of April. And what I said here is, look, I mean, I think the same type of thing is going to happen where, you could have some sideways action for a period of time, maybe get a couple bounces, but until we take out that prior high that we made again on the 20th, that formation is intact. And I did think we're going to have another leg lower. And I do think that 50-day moving average is going to come into play the same way, by the way, Dan, it came into play even more so, if you think about it, in the middle of April, where we actually violated it. So, we'll see. This is not a call on the business of Nvidia, any of the nonsense, that people want to talk about. This is just, in my opinion right now, this is just purely a technical call. And then you want to overlay some fundamentals and some valuations on top, that's fine. But this to me looks a lot like we saw, a couple months ago.
Yeah, I want to make a comment. So, and I think this is a really good daily. Jim Cramer puts out like a daily thing, 10 things in the morning that he finds really interesting, or some big market movers or whatever. And he was talking about, Jensen Huang speaking at their shareholder meeting, I guess. And so he said that Citi raised its price target on club stock Nvidia to 150 per share from 126 and kept its buy rating on the stock. Nvidia holds its annual meeting on Wednesday. High-flying shares have hit some recent turbulence, and this is the most important part. Investors will be watching CEO Jensen Huang to see what else he may have up his sleeve. The terminology, you know what I mean, the phraseology that he used, what else he has up his sleeve. Guy, we talked about this. Remember when they announced Blackwell and then Rubin, and these were the extensions. There it is right there. So this is from Jim Cramer in his morning note. And I think it's interesting because we talked about it at the time, is that H100 going to have a transition to the Blackwell platform, and you're going to need to get that new software to run these new chips. And then they were talking about in 2026. Okay, so that's for 2025. They outlined what Rubin is. Okay, that's a new platform, and it's going to run on new higher end chips and the like here. And I just think it's interesting. And I said it at the time. It's like, you got to feed this beast. This stock is up 200% in a year, you know what I mean? And yeah, like, analysts have been chasing the estimates up, and they've kept on guiding up, but the magnitude of the beats are getting smaller and smaller. So the stock is up, 170% or something like that. This year it was up 200% from a year ago. Like I just said, earnings estimates this year are supposed to be up 100%. Okay. And then if you think about earnings estimates next year, it's going to decelerate off a very high base, right? If you think about it relative to 2 or 3 years ago, but to 33% or something like that. So if you can't keep that going, if analysts have any reason to lower the growth rate next year, then that's a problem for this stock.
I agree. I'll say this and go back to that last slide. I'm not suggesting anything whatsoever, but the phraseology of, something up anybody's sleeve. I mean, that obviously, that's not terminology I would use when describing anything in the marketplace, because it obviously sounds like there's some sort of sleight of hand going on. And I'm not suggesting that's what it is, but it's an interesting choice of words, and it's an interesting choice of a phrase. And to your point, what has to happen is you become a victim of your own success in a certain way, where to your point, you have to continue to feed this beast with news that's going to continue to sort of have your stock on the trajectory. I'll say this, and I've said it before, I think next year, and you can pull it up right now, I think they're scheduled in terms of earnings about somewhere between 155 and 160 billion dollars. I mean, I would suggest that this market cap, that value, that revenue stream has to be double that to be what would be within the norms of historical levels. So if you think that's going to happen, that's fine. If you think that revenue growth is going to slow down, then just on that metric alone, the stock is too expensive.
Well, you made a really good point on numerous occasions. Like, if you think about this stock trades at 45 times this year's earnings, and you think about the way that stock has been growing earnings, that seems kind of fair, right? It grew earnings like 280% last year, right? And it's expected to grow them, 110, 115% this year. So 46 times, that earnings number, it looks pretty good. But to your other point, 25 times sales, because the sales are likely to plateau off at some point, right? That sales growth. And that's the main point. You can run a company more efficiently. You can cut costs. You can buy back shares, right? To do that and manage earnings. But when revenues start to plateau or start to decline, you're telling me a $3 trillion market cap that trades at 25 times sales, that is, if that was 25 times earnings, it would be trading 4 turns over, where the market is trading, which is trading at a, above the 10-year high. I mean, so again, I think those are all great points. I think the multiple of sales is probably a better way to look at this thing right now.
That's what I think. That's what I've thought. But it's been wrong to think that, outside again of that move from early March into mid-April and a couple times and other points on the chart. I mean, that's been the wrong way to think, because right now the market has a complete mind of its own. I do think, though, when the dust settles, there will be an analyst or a group of analysts that come out and make that counter call where they say, okay, this is the concerns that we have. And it's not an indictment on the company. It's more of an indictment on the valuation. and they're going to try to get ahead of something, because right now, as an analyst or as a strategist, you're just standing in the way of the rail. You're just on the railroad track right now, and the train's headed right for you. You have to sort of find a place where that train is going to stop, and then you can be sort of that line in the sand. And I do think that day is coming, probably faster than people realize.
All right, so that's a great point, and I just want to say the customer concentration, okay, at Nvidia, 19% Microsoft, Meta is about 10%, Alphabet is about 7%, Amazon is about 6%, and Dell is about 6%. Okay, so that's about 50%. Well, we've already seen Tesla, okay, move some chips that were supposed to be delivered to them, okay, this is the H100s, over to XAI, which is Elon Musk's, AI company, right? We saw Dell just basically not deliver on the guidance that people expected. Okay, the stock's down 20% from the day before its earnings. So Amazon, Alphabet, Meta, and Microsoft, they're all going to report in about a month from now, and we're going to get a good sense. You know what I mean? Like, Meta sold off 15% or so during its earnings call about a month ago, or about 2 months ago, excuse me, because the revenue was versus the spend. And so like this day is coming, you know what I mean? And it probably comes after the guidance of some of these major customers. So I guess, we can kind of move on from that, if that makes sense.
But just to show how all the oxygen is being sucked out of the room, in the form of Nvidia vis-a-vis other names. I mean, we talked about the impact that it's had on software companies and some of these SaaS models, sort of double whammy in terms of the CapEx going elsewhere and the investors' dollars going elsewhere. But look at a Qualcomm, for example.
Yeah.
Again, very quietly, they've had a pretty significant downdraft in this name without anybody paying attention. And you're right up against, I want to say it's the 50-day moving average, which has been support before. But the only reason I bring it up, because, there are others. I mean, AMD is going to look very similar, by the way, if not worse. I mean, there are other stocks in that same universe that have not traded particularly well over the last couple of weeks.
Well, AMD has not participated in this latest leg of the rally. And so I think that's kind of interesting because, Lisa Su, the CEO of that company, has been on CNBC a couple times over the last few months. She tells a very good story. She raised the TAM, the total addressable market for the chip space, the high-end GPUs, but the stock has just gone sideways. If you think about that, and look at that 200-day that it's holding. Again, technicals, don't mean a whole heck of a lot if you're kind of struggling with some fundamental issues, but they do kind of tell a little bit of the story here. And I think your point about Qualcomm is really interesting because that stock also has major customer concentration. 27% of their sales comes from Apple, and 22 or 21 or so comes from Samsung. And to me, and I said this, I think earlier or maybe last week on Market Call, I think that Apple, maybe we can throw Apple up because it got an upgrade today, and the stock, is on its horse a little bit. It's up a little more than 2%, and it's getting back towards those highs post WWDC when they announced Apple Intelligence. But to me, I think one of the first major disappointments in this trade, in this generative AI trade, might be iPhone 16 sales. Okay, because I think when they introduce Apple Intelligence, the actual software, I think it's going to be buggy. I don't think it's the sort of thing that is going to be all there. I think also that if a lot of consumers, like Apple iPhone users, they've just written off Siri. So all of a sudden, Apple's going to say that you're going to be dependent on Siri for Apple Intelligence, right? Which is going to license, OpenAI, probably Gemini, probably Meta AI. These are all rumors other than the OpenAI. Well, right now, you can do that on your crappy 14 or your 15. You don't need to upgrade to a 15 Pro or a 16 Pro next year to kind of use Apple Intelligence because it's not going to be all there. You know what I mean? Like that's just my 2 cents. So when and this is going to take a couple months after the introduction of the phones, but if they don't see a big upgrade cycle with the 16, then this stock is way too expensive, guy. I mean,
yeah, it is. Look, it is expensive, and let's layer on this. I mean, you don't often see this, and if we get Carter this week, he can take a look at it, and I'm sure he'll be better suited than I. But take a look at this chart and go back to like February. And for the first time in probably a very long time, you saw the 50-day moving average cross through the 200-day moving average to the downside. And the stocks, to a certain extent, acted in kind. We had a follow through into the spring. But just as abruptly as that happened, look what's just recently happened, where you've had now the 50-day cross back up through the 200-day. So, that juiced move from 180 to 210-ish, I mean, really got that 50-day moving average back on the horse. And now, as bearish a formation as it was earlier this year, that's as bullish a formation as it is now through some people's eyes. Other people will say, man, oh man, there's a lot of turbulence here. How is this going to sort of play itself out? So, as much as I would love to say, this should be extraordinarily bullish, the 50 go to the 200. Well, it should have been extraordinarily bearish when it happened, 3.5 months prior. So a lot of strange things happening and a lot of different stocks. Dan.
Yeah, you and I said this when the stock was 170. Okay. We thought that Apple is probably, I said it on Fast Money, I said it on Market Call. I said that if this company guides, just inline and just has an inline quarter, because remember a lot of the data was tracking very poorly for iPhones, in the first, part of the quarter in Q2. And we said, if the guide is not great and the stock sells off, or even if it just trades around there, in that 170, 165 range, that was the low, right, from a couple weeks earlier, then it probably is a great trade into WWDC or into the fall, because it's totally underappreciated as far as what their opportunity is in the space, even being a laggard. And none of us thought that they were going to be spending tens of billions of dollars, building a foundation model. You know what I mean? They're good at aggregating stuff, right? And that's what they were going to do. And they're a gatekeeper as it relates to services, as it relates to the App Store, right? And they love taking 30% of every app that's sold on there. So they didn't have to do that. And that is what they're going to be doing. So I actually think it makes sense on a longer term basis. But I think the stock move, and we talked about this on Fast Money, it's pulled forward a lot of potential, you know what I mean, what's going to happen on the back half of the year. And I just don't think it's going to materialize that way. So I would expect the stock to pull back to that breakout level. Maybe it's 197 or something like that. And then maybe that's where you start thinking about it. But again, I think it's going to be disappointing in the fall, and you might not see that until January, until a lot of the numbers are released. But so this is going to be a tough trade. But I think at some point, it probably has to come in a little bit.
I agree. And what we've seen recently is just sort of, that, I don't want to say pent up, because I rarely use that term, but I think Apple finally joined or attempted to join the party in the form of stock performance. Because quite frankly, until a few weeks ago, the stock had really done nothing for the last year and a half or so. It's been sort of sideways on a broader tape that's done well. Quickly, Micron, because I got to tell you something. I don't know what to make of this. I know a lot of people are completely geeked up in earnings. I know a lot of positive commentary around Micron, given that they're sort of, adjacent. It's the word you use, the term you use correctly, to the AI trade. Implied move of 12%, which is probably, I'm going to say this. It's probably going to wind up being bigger than that, quite frankly, given where we are and given some of the expectations, Dan.
Yeah. So reports after the close in 2023, this is a company that did about, in calendar year, nearly $30 billion in sales. 2025, so the out year, next year. Okay. So they're in, expected to be, maybe close to 40 billion. And, the company is growing revenues again for the, first time meaningfully in a while. I just want to make the point that in 2022, this is a company that did, on the calendar year, $26 billion in sales, and that went down to 17 in 2023, right? So we've talked on many occasions, the memory market, very commoditized, but also very volatile, right? And so this stock joined the party, the AI adjacent party, because they started making a case how, memory is going to be a really important part of these large language models, these data centers and the like here. So, that stock took off in late March. It had been trading at a 52-week high, but it gapped above $100 and traded as high as, 158 or something like that just a few trading days ago. So a 12% implied move into the earnings tonight. Listen, if you have a 12% implied move, the at the money call or the at the money put is about 6% of the stock. Now that seems like a lot, but if you have a position and you have conviction longer term to that is going higher, but you're worried about the near term guidance, not too different. Maybe they can pull Dell up for a second here, because the people who are pretty excited or geeked up, as you just said, about Dell into its print. Look at that massive gap that we saw. Tried to fill it in and then came all the way back, and it's kind of leaning on that 50-day, like you just mentioned. I could see a move like that in Micron, not because they're not doing anything well and not executing well or whatever, but people got in front of this move, right? And so into earnings, I just would be shocked if the thing was up 10, 15% to the upside. But again, we get things
Stranger
wrong.
things. We're running. I know we're running up against it. Real quick, go back to Dell because we actually thought that it could trade down to 128, which I think it actually violated that. I think it got a little bit lower, but whatever. But it basically held, and this, quite frankly, again, given the environment that we're in, once it held, it should have gone, and it certainly looked like that was going to happen. But to your point, pretty much given not the entire thing back, but a large portion of it back, which I would say is concerning. That's just me. We're going to have Ben Wrightsies on tonight on Fast Money, and I'm sure Dell will come up. So I just wanted to throw that out there. So that's Micron. We got to talk about Tesla, not briefly, because I just want to make this point. A couple of weeks ago on Fast Money, I think there were 2 analyst calls. Somebody had a $125 price target, and I think on the same day, somebody put a $200 price target-ish, something like that. And Melissa asked me what I thought, and I said, it's funny. I'm not trying to be glib or amusing here, but I think they both can wind up being right because we have seen moves to the upside along the way on what's been a downtrending stock. So I think there's a real chance for this stock to sort of gap back to that 200 level before we sort of can have that continuation of a theme to the downside. So actually, it's sort of playing out here, Dan.
Yeah, and listen, you just look at that formation. It's above the 50-day. It's been consolidating above that from a technical level. You see that like 200-day moving average. It's going to get to that $200 level, which would basically be very close to filling in that gap, right, that we saw in early January. That was based on, disappointing earnings and the like. So, when we get into early July, that's next week, we're going to get June delivery numbers. And a lot of folks think that, Q2 deliveries, at least consensus on the street, is still kind of high. But I guess the really important part about that is that's kind of baked in the cake right here, right? So investors know that there's a problem. They know that there's an inventory problem. They know that there's a lot of competition coming from China. And a lot of pricing pressure, right? And so again, if this company just comes in, let's say, in line with consensus, that would be a huge beat, to like, I think the whisper. Does that make sense in a way, Guy? And so then you look at that, it looks like a head and shoulders bottom. You see where the resistance is, you see where that gap, where could it go at that point? Because, we're kind of in Sillyville in some other stocks. There's no reason why this thing couldn't join the party. I think you and I have also been in the camp where if you want to try to press this on the short side, you got to do it with defined risk, right? We detailed, a put calendar, I want to say like a month ago, targeting that 170 strike. We reduced the price of that 170 put. But again, this thing looks like it's poised to rally. And if those delivery numbers come out next week and the stock doesn't sell off, if they're disappointing, then it probably has some room to the upside.
I want to run through a couple things here because I think they're all sort of attached at the hip. So the first thing I want to take a look at are 10-year yields, which today are up about 7 basis points or so. So my view on yields. I don't want to belabor this, but I think a lot of what we're seeing today in yields has to do with the next chart I want to look at, which is dollar yen. And dollar yen is having a crazy move, in the absence of intervention, the yen is going to continue. And that's something, by the way, we've said for a while. I mean, I remember in April when they intervened twice and they got it from 160 down to 152, they being the Bank of Japan. I didn't think it would last long, and that proved to be correct. But, now it's sort of left to its own devices. You can see what the yen wants to do. So I think the weakness in the yen, Dan, is contributing to the weakness in yields or yields going higher. And I think they're somewhat part and parcel. Then we can look at a broader dollar chart, and this is something that you've brought up on our shows and on Fast Money, and you take a look at the strength of the dollar recently, and it's like, there's a lot of things going on. We've been in this up channel for a while. We traded down to the lower band of the channel. We're smack in the middle of it now, which theoretically is where we should pause. But, it's all part of that same mosaic.
Yeah, and we've also talked about the fact that when we saw the U.S. dollar acting inverse to yields over the last month or so, right? So the 10-year yield went from 4.75 down to 4.25 or so, maybe a little lower than that. The dollar kept on moving higher, right? And so here we are now. If yields were to take off, and we know we have PCE, this week, we have jobs next Friday, right? Let's say those come in a little hotter. then you're going to see the yield on the 10-year probably back at 4.5%. I expect you see the Dixie, probably, up a buck, maybe 107 or something, if that's the case. And then let's look at this, the euro here, Guy, because, well, this is the Dixie. Okay, so really quickly, like you see that pattern right there. Like that looks like it wants to break out a little bit, right? And so I think that's a really interesting one. But even if we're to just kind of get repelled at that downtrend, you know what I mean? You don't have, it's getting narrower and narrower, right? So feels like a little bit of a coiled spring.
Something's got to give here. I mean, there are a lot of moving parts, and that gets us, if you want to look at the BKX, the KBW Bank Index,
Yeah.
I mean, that is obviously nowhere near its prior high. We had this little move to the upside, but we're starting to roll. We've talked about the KRE, which is going to look probably similar in a long-term chart. You obviously had that trough like many of these banks did when Silicon Valley Bank blew up. You've had a subsequent rally, but that's seemingly starting to roll now as well. So just a lot of things. Again, there's a lot of things to love in the market, and we've talked about some of them, and there are a lot of things to be concerned about, which have not made their way into the S&P, but it doesn't mean they're not still there.
Yeah, move up in yields, bad for banks. Okay, let's just be really clear about that. And again, there was a period this year where yields were higher, banks were making new highs every day. But again, who knows? All right, this is really interesting. This is from our main man, John Butters. He's the senior earnings insight analyst over at FactSet, one of our fine sponsors. Every Friday, Butters writes the earnings insight report. You can have it in your inbox. You just got to go to insight.factset.com/subscribe. We get, Guy, a preview of it on Wednesdays or Thursday, typically Thursday, but we thought this was a really interesting one to talk about today. All right, so this is the chart here, Guy. You see that, what's going on here? The Q2 bottoms-up EPS estimate for the S&P 500 has decreased by 0.4% during the second quarter. This decline is much smaller than the 5-year average, down 3.4%, and the 10-year average of 3.3%. So what's interesting here is that we've talked about this, and Butters' work suggests that earnings estimates basically come down. You can just see this about 3.3% over the course of a quarter. The fact that they're only down 0.4%. Now, here's the thing. Okay. And I just want to make this point, Guy. So as we head into Q2 earnings season, we have the major indices trading at, pretty expensive levels. You have the indices very near all-time highs, just come off a little bit recently. Would you rather have expectations if you're long the market high or low? You know what I mean?
Yeah.
And so what this speaks to me is that expectations are building higher. Does that make sense to you?
100%. And Elizabeth and I had a similar conversation last week. And I don't know if we can put it in show notes. I'm not very good at that. But what I'll say is, that's the very similar conversation to what we had last week in terms of, again, a similar piece of work that John did. We looked at it through a little bit of a different lens, but it tells effectively the same story. And we commented how, energy was sort of the outlier last week, and it's the outlier again this week. But to specifically answer your question, I think if one is bullish, you want expectations on the weaker side of things as opposed to people getting more encouraged. And that's just the way I think a lot of people think.
Yeah, and to your point about the energy sector, so this is the next kind of chart here. I think this is interesting, Guy, and it speaks to kind of what we were just talking about more at the start of the show with the narrowing breadth and who's doing all the heavy lifting. At the sector level, the energy sector is expected to see the largest price increase. On the other hand, the information technology sector is expected to see the smallest price increase. So this is kind of interesting, right? So the info tech sector, okay, which we know has been very responsible for a lot of the gains, the stocks, again, are trading at levels which just, suggest to me that the expectations are high, yet the expectation for a price increase, you know what I mean, as it relates to EPS estimates and the like, are kind of the smallest thing. So again, interesting that the price performance seems to be outweighing some of the expected earnings estimates.
No doubt about it. And again, you should get Butters' work in your inbox because it's non-dogmatic. He just throws it out there and he allows you to make the decisions based on his work. I mean, he's not suggesting anything here other than, your interpretation of what this data says. So we're lucky to have him. So quick couple questions. This is from Ramesh B. Merck is making a 52-week high. It's actually an all-time high, but that's fine. Yearly gains pale in comparison with Lilly and Novo. Why are you guys still bullish on Merck? Well, I'm bullish on. Okay, so Dan, you can pull this up, but I think I got it off the top of my head. So right now, Eli Lilly's about an 800, I think, and $70 billion company or so. That's going to do approximately $52 billion in revenues next year. Merck is about a $340 billion company that's going to do, I think, approaching $70 billion of revenue next year. So if you think about it, just through that metric alone, Eli Lilly's sort of expensive. Merck is rather cheap. Now, you're going to say, well, wait a second. You're not taking in consideration the growth engine of the GLP-1s that Eli Lilly has and Novo has and Merck does. Absolutely. All I've been saying for quite some time is it's not a reason to sell Lilly, but it's a reason to take a look at Merck and say, wait a second, just on that metric alone, Merck is too cheap. And by the way, that's been right. It has not had the moves that Eli Lilly has had, but it doesn't mean you shouldn't be bullish on Merck here. So to me, it's not zero sum, and that's just sort of the math I wanted to bring across.
That makes sense. And actually, if they can pull up a 5-year chart of Lilly and you look at the price performance, you could say, oh, that looks like Nvidia, right? And they have, they're in the catbird seat like Nvidia is on a huge mega trend with this GLP-1s. And, it's trading about 20 times sales. So it is an 850 billion market cap guy that is expected to do $43 billion in sales, $53 billion in sales next year. So up 26% year over year this year, 23% expected next year. Could that number go higher? Sure. But these are all of these companies are supply constrained, right? As it relates to these GLP-1s. And we had this discussion on Fast Money last night, Guy. Like, okay, so these stocks gapped up because the Chinese approved these drugs. There's no supply. They're not going to get them for 1 or 2 years. And then, by that time, the Chinese are going to kind of come up with their copycat versions or whatever. So again, there's going to be competition. Melissa made this point. There's going to be orals. There's going to be a whole host of other things. Now, you could come back on me and say, well, they're going to start prescribing it for sleep apnea, for heart conditions, for a whole host of other things. Well, that's great if they have the supply, right? You know what I mean? So that's my 2 cents there, but I agree with you on the Merck. And as far as Lilly, love what they're doing, love the company, don't love the 20 times sales valuation, 16 times next, especially when you consider there's going to be some competition coming online.
We have gotten to be pretty good friends with Stuart Sopp of Current, and we're fortunate that, we see him almost on a daily basis, but in a prior life, he was a currency trader. And that leads me to this next question from Wavy McFly, who's here every day. And apologies that I'm reading. Well, I'll read it from here. Guy, have you been following what's going on at Norinchukin Bank in Japan and Japan Post Bank? This seems to be the epicenter and thread that unravels the dress. The answer is yes. And I mentioned Stuart because he actually sent me something on that last week, and I'd been somewhat aware of it. But, the losses that are mounting are pretty staggering. And, I think one has it somewhere between $65 and $80 billion of potential losses. So, yeah, and I think, that's all part and parcel of some of the things we're seeing. And I think it has something, I'm not saying it's knee-jerk reaction to the yen or one's doing the other, but there are clearly things going on that the broader media has not picked up on. And I'll send Amanda what Stuart sent me, and we'll put that in the show notes as well. But I'm absolutely been watching that as well. Real quick, Adam Beauregard, finding it hard to stay in one stock very long. How do we control fear of loss in such a volatile market? Well, what's funny about that is it hasn't been volatile at all, Adam. I mean, through the lens of the VIX. I mean, some of these moves in single stocks have been crazy. But this is what I say. I'll say this all the time, and hopefully this makes sense before we get out of here. Trade the stock, don't let the stock trade you. And what does that mean? Well, it basically means, if I told you could buy something for 60, and if I said to you it's going to go to 90, you'd say, sign me up right now. And I think a lot of people will feel that way. The problem is, it goes from 60 to 90, and you're like, oh my God, this is going to pay my kids' tuition. And you start having these delusions of grandeur. You have to have a plan before you get into a trade. And the plan has to have an exit strategy if you're wrong, but it also has to have a strategy where if the stock were to rally 15 or 20%, I'm going to get out of a quarter or a third, and then I'm going to look to buy it back if it pulls back 10%. So the plan has to be on place. So to a certain extent, once you put on that trade, it has to be on autopilot. If you don't, what's going to wind up happening is you're going to be paralyzed by the inevitable moves both for and against you.
Yeah, good stuff, Guy. I appreciate that. We should do more of that little trade school sort of stuff because I think it's helpful to a lot of folks. Great stuff. Okay, really quickly, if you're here and you're watching this, some people listen. We get it. You're out and about. You're doing a whole host of different things, but the audience builds for this over the course of the day. So we really appreciate those who are watching it, those who listen to it because it's doing well, also on the audio. But we just launched 6 weeks ago, Guy.
I was
6
right,
weeks
by the way.
ago. I know you were. I mean, I give you, do when you do it all the time. Okay. But I said do. But the market matrix, you see it right there. We launched this 6 weeks ago. We're really excited about it. Our team curates what we think are 10 of the most important stories in the markets and the economy. And we have them summarized by a very cool AI bot. Then we have an AI bot read it to you. You don't even have to listen to Guy in my voice at all. His name is Brunson, and he's not even a he. He just exists in the ether there. But go to your favorite podcast store, subscribe. It's MRKT Matrix. Rate it, review it, listen to it, share it. We really appreciate that. We're really excited about this. I listen to it every day, and I think it's a really good thing to end the day and get prepared for the next day. So it's Market Matrix. Guy, that's it. I'm out.
That's
You're
it.
out.
And by the way, Brunson was a good call because last night the Knicks traded for yet another Villanova grad. And I know Knicks fans are elated with that move. Yankees lost last night. I'm not happy about it. I'm not hiding from it.
Who'd they lose
But,
to?
they lost to the Mets.
Yeah.
That's it. That's all I have to say.
What did Tim Seymour say to you on the set? So he's a big Mets fan.
Tim knows how to push my buttons the same way I know how to push his buttons.
It was really good. What did he say?
He basically said, this series is more important for the Yankees. And his point is like the Yankees, for the Mets, if they lose, it's not a big deal. People expect them to lose. For the Yankees, it's a lose-lose situation. And that's the arrogance of a Yankee fan talking. But it also happens to be true.
Right.
He will gloat later when I see him.
What he said to you is there's no upside for the Yankees in these 2 games.
Right.
All right, listen, we're out of here, people. We really appreciate you being here. We're going to be back tomorrow on the Market Call. And we also have a great guest on the tape tomorrow. Danny Moses, Guy Adami, myself. We're going to be sitting down with Morgan Stanley's Mike Wilson. And so we do that once a quarter with Mike. He's very gracious with his time. And you and I, Guy, and Danny, we think he's one of the smartest guys in the street. We've known him for decades. So we're excited to hear what he's got to say. That will drop on Friday in the podcast stores. If you don't follow on the tape, please do. Get it, rate it, review it, share it. Enjoy the pod. All right, Guy, I'll see you tomorrow, bud.
Later, peeps.